By all accounts, it appears that the stars have aligned for a once-in-a-generation opportunity to overhaul the U.S. tax system. And right now, the main proposal on the table is the GOP Better Way blueprint that was designed by Speaker Paul Ryan and Ways and Means Chairman Kevin Brady. And while the most talked about part of this comprehensive plan, and it is a comprehensive plan, we have to remember that, but the most talked about portion, as you know, is the transformation of the current corporate income tax into what's known as a destination-based cash flow tax system.
So why do we think about a cash flow tax? That's not the only option out there. So income is broadly difficult to measure and subject to a lot of gaming on the part of corporations. So cash flow is a simpler way to go. And then the idea would be eventually that all businesses and not just corporations would be taxed under the system, although what we're going to consider right now is just going to be subchapter C corporations. One of the problems with the current tax system is that it subsidizes debt over equity. So something like a cash flow tax would equalize the treatment of those two. Economists will tell you that this is economically equivalent to the destination-based value-added tax, so a VAT, but with a deduction for labor. So what is the border adjustment? This is, again, something that people are thinking very hard about right now and what its implications are. So in a destination basis, what we take is the domestic sales of goods and services, so everything you buy in the US, less the domestic expenses incurred. And so what this means in particular is that purchases from foreign parties are no longer deductible. So if you're importing pieces to your production process, you don't get to deduct those costs in a border-adjusted cash flow tax. And then sales to foreign purchasers are no longer taxed. So if you bake a loaf of bread and you sell it in Canada, you don't get to deduct the cost of tax. And why am I talking about baking? Because I have an example here. Just to get everybody on the same page about what's going on. So in this economy, there's a farmer, miller, and baker. And so the farmer, say, buys its seeds in Canada. It sells its goods to the miller. The farmer is going to take the seeds, grow something, sell them to the miller. The miller buys them domestically and then sells the flour to the baker. So the baker is buying all of its inputs domestically, but then the baker sells some pieces of its process in the US and then, say, some in Canada. Okay? So we can look at what happens to the miller. Remember, the miller did everything in the US in this example, and so there's no change in their basis from a cash flow tax to a border-adjusted cash flow tax. They're totally unchanged. What you want to think about is the farmer and the baker. So for the farmer, he bought the seeds, say, in Canada, and he normally deducts those from his taxable income and ends up with a cash flow base of $100. We're going to deny the deduction, and so we've increased the taxable income of the farmer. So his liability is going to be bigger for the same rate with the border-adjusted cash flow tax and with the cash flow tax before border adjustments, or an origin basis. And then the baker, we haven't increased his tax liability. We've actually moved him into a loss position because we removed from the tax base the bread that he sold to, say, Canada. So you don't you don't tax the $300 of income, and we move him into a loss position. And so what we're trying to think about in this paper is how many farmers are there and how many bakers are there in the US system, because how you treat those under a destination-based cash flow tax is going to affect what the impact of the cash flow tax is.
It's not a partisan proposal in the traditional way that we think of partisan politics. This is not a traditional supply-side proposal. This is a proposal that has, I think it's fair to say, nonpartisan roots.
I do think that just staring at that difference between the origin cash flow tax and the destination-based cash flow tax, the tax base, just tells you why this is such a hot-button issue, right? That sort of the amount of revenue on the table in moving to border adjustment is enormous, and for that reason, it's going to attract a lot of attention.
We know why we want to cut the corporate tax rate. It distorts investment choices, as Elena said. It distorts financing choices, preferring debt over equity.
This is the calculation that the tax department and every major corporation did the moment the House blueprint came out. They sort of said, what will happen to our taxes? And that's not really the right calculation. The right calculation is what will happen to our after-tax profits in the presence of this reform and in the absence of this reform. And you can inform that discussion well. It's a different question, but there is some combination of faster economic growth and currency appreciation which would hold a firm harmless in terms of their net income, and some will benefit. I want to congratulate Elena and her co-author. This is a really important moment. To date, there's been a really interesting abstract tax policy discussion going on in Washington that's been uninformed by any facts. And this is a fantastic contribution.